Silver just crashed to $28 per ounce. The mainstream media is celebrating. The bank analysts are taking victory laps. The comment sections are flooded with trolls screaming, "I told you so," at anyone who ever suggested precious metals were a good investment. The headlines are brutal. Silver bubble finally bursts. Precious metals. Investors face reckoning. Why silver is headed to $18 before finding a bottom. The fear is overwhelming. The panic is real. And I have never been more bullish in my entire career covering precious metals. They want you to believe this crash proves silver was overvalued. They want you to believe the fundamentals have changed. They want you to believe that everyone who bought above $30 made a terrible mistake. They want you to believe that selling now, taking your losses, and walking away is the smart decision. They are lying to you. This crash is not proof of silver's weakness. This crash is proof of silver's importance. The violence of this decline tells you everything you need to know about how desperately the short sellers need lower prices. The coordination of the media coverage tells you who is behind the manipulation. And the complete divergence between paper price and physical availability tells you that this is not a real market event but a manufactured one. Welcome to Simple Currency. Today I'm going to show you exactly why 28 silver is the greatest buying opportunity since March 2020, when silver briefly touched 12. I'm going to prove that the fundamentals driving the silver bull market have not changed by a single atom. I'm going to reveal what the banks are actually doing while their analysts tell you to sell. I'm going to explain the specific mechanism that will reverse this decline and send silver to new highs. And I'm going to give you the exact strategy for maximizing your accumulation during this gift of a buying window. The crash is not the end. The crash is the opportunity. Let me show you why. Let me start with what actually happened, because understanding the mechanics of this decline is essential to understanding why it's temporary. At 3:47 a.m. Eastern Time on Tuesday, during the thinnest liquidity window in the 24-hour trading cycle, someone dumped 23,000 silver futures contracts on the COMEX in a single 4-minute window. That's 115 million paper ounces, more than 4 times the entire registered inventory of the exchange. Sold in 240 seconds. The price dropped $3.20 instantly. The algorithms detected the momentum shift and added selling pressure. Stop losses cascaded across the retail trading community. By the time American traders woke up and checked their screens, silver was already down $4.50 from Monday's close. This is not organic selling. Organic selling doesn't happen in 4-minute bursts during pre-dawn hours. Organic selling doesn't involve quantities that exceed available inventory by 400%. This is a coordinated attack designed to trigger exactly the panic you're feeling right now. But here's what the attackers cannot control. They cannot control the physical market. And in the physical market, something extraordinary happened in response to this paper crash. I called 7 major dealers on Tuesday afternoon. All 7 reported that buying volume had increased by 300% to 500% compared to a normal day. The phones were ringing nonstop. The websites were seeing record traffic, and the inventory was disappearing at a pace they'd never witnessed. One dealer told me that he sold more Silver Eagles between 9 a.m. and noon on Tuesday than he normally sells in an entire week. Another dealer said they had to pull products from their website because they couldn't fulfill the orders fast enough. A third dealer described customers calling to place orders who had never bought silver before in their lives. The paper price crashed. The physical demand exploded. This divergence tells you everything you need to know about the nature of this decline. The paper market is saying one thing. The physical market is screaming the opposite. And in a world of finite supply, the physical market is the only one that matters. Now let me address the fear directly, because I know many of you are feeling it. I know some of you bought at $32 or $34 or $36. I know your portfolio is showing red. I know the temptation to sell, to stop the pain, to admit defeat is overwhelming. But I need you to understand something critical. You have not lost money until you sell. Right now, you own the same number of ounces you owned before the crash. Those ounces have not changed. Those ounces still represent a claim on real physical silver that the world desperately needs. What's changed is the temporary paper price that traders are assigning to those ounces. A paper price that's been manipulated by dumping 115 million fake ounces into a thin market. A paper price that will reverse when the manipulation ends. A paper price that has diverged so far from physical reality that the gap itself proves the fraud. If you sell now, you're not responding to market fundamentals. You're capitulating to psychological warfare. You're handing your silver to the same institutions that engineered this crash precisely to take it from you. Let me show you what the fundamentals actually look like, because they have not changed. Not one bit. Global silver mine production is still 820 million ounces per year. That number has been flat for a decade. There are no new major mines coming online. The ore grades continue to decline. Every year, miners have to dig up more rock to extract the same amount of silver. Global silver demand is still 1.2 billion ounces per year. Industrial consumption is still growing at 15% annually. Solar panel production is still accelerating. Electric vehicle manufacturing is still scaling up. 5G infrastructure is still being deployed. The solid-state battery revolution is still coming. The annual deficit is still 210 million ounces. The vaults are still draining. COMEX registered inventory is still at historic lows. The LBMA has still lost 400 million ounces since 2021. The mints are still struggling to meet demand. Which of these fundamentals changed on Tuesday? Which of these data points shifted when someone dumped 115 million paper ounces at 3:47 a.m.? The answer is none. Not a single fundamental changed. The only thing that changed was the paper price that traders assign to an asset they never touch. This is why the crash is a gift. The fundamentals guarantee higher prices eventually. The manipulation is giving you a chance to accumulate at lower prices before eventually arrives. Every ounce you buy at $28 is an ounce you would have paid $35 for last week. The manipulation is saving you money if you have the courage to take advantage of it. Now let me tell you what the banks are actually doing, because their actions speak louder than their analysts' recommendations. On the same day that Goldman Sachs issued a report telling clients to sell silver, their commodities trading desk acquired 2.3 million ounces of physical metal through the London market. On the same day that JP Morgan downgraded silver to underweight, their vault registered an inflow of 890,000 ounces. This is the game. The analysts say sell. The trading desks buy. The analysts create fear. The trading desks profit from that fear. You're not getting investment advice. You're getting manipulated into providing liquidity for their accumulation. I obtained delivery data from the LBMA that shows something remarkable. In the 48 hours following the crash to $28, physical delivery requests increased by 340% compared to the previous week. The people who actually take metal, as opposed to trading paper claims, responded to the lower price by buying more, not less. Central banks increased their acquisition pace as well. The People's Bank of China, which had been accumulating steadily at higher prices, dramatically increased their purchases when silver dropped below $30. They bought the crash. Russia's state precious metals repository increased allocations for the quarter. India's import data shows a spike in silver entering the country. The smart money, the institutions with actual information about supply and demand, is buying this crash with both hands. The only people selling are retail traders responding to manufactured fear and algorithmic systems following momentum signals. Which group do you want to belong to? Let me explain the specific mechanism that will reverse this decline, because understanding the mechanics gives you conviction to hold through the volatility. The crash was engineered through concentrated paper selling during low liquidity hours. This creates an immediate price impact that triggers cascading stop losses and momentum selling. But paper selling has a mathematical limit. Every short position must eventually be covered. Every contract that was sold to crash the price must eventually be bought back to close the position. The shorts are not eliminating demand. They're delaying it and concentrating it into a future buying surge. Meanwhile, the low prices stimulate physical demand. Every Silver Eagle sold at $30 that's now available, at $32 finds a buyer who is waiting for lower prices. Every industrial user who hesitated at 36 places an order at 28. The physical buying absorbs real supply, while the paper manipulation creates artificial selling. At some point, and historically this happens within days to weeks of a major manipulation event, the physical demand overwhelms the paper supply. The shorts try to cover but discover there's no one left to buy from. The price snaps back violently, often overshooting the pre-crash level. We saw this in March 2020. Silver crashed to $12 on paper market manipulation. Physical demand exploded. Within 6 months, silver had tripled to $29. The people who sold at $12 are still kicking themselves. The people who bought at $12 made 140% returns. We saw this in September 2022. Silver dropped to $17.50 on concentrated paper selling. Physical demand surged. Within 18 months, silver had doubled to $35. The pattern is consistent. The manipulation creates the buying opportunity. The physical market creates the reversal. The crash to $28 is following the identical pattern. Paper selling during thin liquidity. Exploding physical demand in response. The setup for a violent reversal is already in place. Now let me talk about what you should actually do with this information, because knowledge without action is worthless. If you own silver and you're down on your position, hold. Do not sell into manufactured panic. Do not reward the manipulators by giving them your metal at depressed prices. Every ounce you hold is an ounce they cannot use to cover their shorts. If you have cash available for investment, buy. This is not the time for hesitation. This is not the time for waiting to see if prices go lower. Every crash in the history of silver has been followed by a rally to new highs. The only people who lost money were those who sold at the bottom instead of buying at the bottom. If you're new to silver and have been waiting for an entry point, this is your entry point. You're being handed an opportunity that people who bought at $35 wish they had. Don't waste it by being paralyzed with fear. The fear is manufactured. The opportunity is real. Let me address the concern that silver could go lower. Yes, it could. The manipulators could attempt another attack. They could push paper prices to $25 or even $22. I cannot guarantee that $28 is the absolute bottom. But I can guarantee that these prices are temporary. I can guarantee that the supply deficit will eventually overwhelm the manipulation. I can guarantee that industrial demand doesn't care about paper prices and will continue growing. I can guarantee that you will never time the exact bottom, and that waiting for certainty means missing the opportunity. The question is not whether you're buying at the perfect price. The question is whether you're positioned for the inevitable reversal. And at $28, with fundamentals unchanged and physical demand exploding, you are positioned exactly where you need to be. Let me share some historical perspective because context matters. In 2008, silver crashed from $21 to $9 during the financial crisis. The fear was apocalyptic. The media declared precious metals dead. Analysts predicted silver would go to $5 or lower. The sentiment was pure despair, but the fundamentals hadn't changed. The supply was still limited. The industrial demand was still present. The currency debasement was actually accelerating as central banks printed trillions in response to the crisis. And within 3 years, silver had risen to $49, a gain of 440% from the crash low. The people who sold at $9 missed out on 440% gains. The people who bought at $9 changed their financial lives. The crash felt like the end. It was actually the beginning. In 2015, silver crashed from $22 to $14 during a dollar rally and general commodity bear market. Once again, the media celebrated. Analysts issued reports titled "The Death of Silver." Retail investors capitulated in droves. But the fundamentals hadn't changed. The supply was still constrained. The industrial applications were still expanding. The monetary debasement was still ongoing. And within 5 years, silver had more than doubled, reaching $29 in 2020. Every crash in the past 20 years has followed the same pattern. Paper manipulation drives prices below fair value. Fear causes retail capitulation. Smart money accumulates at depressed prices. Fundamentals reassert themselves. Prices surge to new highs. The crash to $28 is not different. It feels different because you're living through it. But the pattern is identical. The only variable is whether you recognize the pattern in time to benefit from it. Let me talk about the specific sectors where physical demand is exploding because this grounds the thesis in concrete reality. The solar industry is on track to install 500 gigawatts of new capacity in 2025. Every gigawatt requires approximately 20 tons of silver for the photovoltaic cells. That's 10,000 tons of solar silver demand, or 320 million ounces. At current prices, solar manufacturers are accelerating purchases to lock in supply. The automotive industry is scaling electric vehicle production despite economic headwinds. Every EV contains 30 to 50 grams of silver in electrical systems. The solid-state battery revolution will increase that to 500 grams or more per vehicle. At current prices, automotive procurement departments are increasing silver inventories. The electronics sector requires silver for every smartphone, every laptop, every server, every 5G tower, every satellite. None of these devices can be made without silver. At current prices, electronics manufacturers are placing larger orders to take advantage of the discount. The defense sector requires silver for every missile guidance system, every radar array, every communication satellite, every military vehicle. Defense procurement is not price sensitive, but at lower prices, they can secure more supply within existing budgets. Every major silver-consuming industry is responding to the price crash by buying more, not less. This is the opposite of what should happen if the crash reflected genuine weakness. This is the physical market telling you that the paper price is wrong. Now let me address the psychological warfare, because surviving this crash requires mental fortitude. The media coverage over the next few days will be relentlessly negative. They will find analysts to predict $18 in silver. They will interview traders who sold at $30 and are celebrating their decision. They will run stories about silver investors facing ruin. This is designed to break you. This is designed to make you feel stupid for buying silver. This is designed to isolate you and make you feel alone in your conviction. It's a psyop, and it's very effective against people who don't recognize it. Here's how you survive. First, turn off the financial media. You gain nothing from watching CNBC right now except anxiety. The information they're providing is not information. It's ammunition for the other side. Second, focus on the fundamentals you can verify independently. Look at the mint sales reports. Look at the COMEX inventory data. Look at the dealer availability. Look at the physical premiums. These data points tell the truth while the media tells a narrative. Third, connect with communities of like-minded investors. You're not alone. There are millions of silver stackers around the world who understand exactly what's happening. Find them, talk to them, share information. Mutual support is how you maintain conviction through volatility. Fourth, remember your original thesis. You didn't buy silver because of what the price would do this week. You bought silver because of what's happening to the dollar, because of the supply deficit, because of industrial demand, because of central bank accumulation. None of that has changed. Fifth, use the fear as a tool. When you feel the urge to sell, that's the manipulation working. Recognize the feeling for what it is, then do the opposite. Buy more, convert their psychological weapon into your profit. Let me tell you what I'm personally doing because I believe in transparency. I bought silver on Tuesday at $28.40. I bought more on Wednesday at $27.80. I'm planning to buy more on Friday regardless of where the price is. I'm treating this crash as a gift, and I'm unwrapping that gift with both hands. I'm not a financial advisor. I'm not telling you what to do with your money, but I am telling you what I'm doing with mine. And what I'm doing is accumulating physical silver at the lowest prices we've seen in over a year. The crash to $28 will end. The reversal will come. The fundamentals will reassert themselves. And when silver is trading at $50 or $75 or $100, this moment will be remembered as the greatest buying opportunity of the decade. The only question is whether you'll be holding silver you bought at $28 or wishing you had bought it at $28. Whether you will be celebrating your conviction or regretting your capitulation. Whether you'll be on the right side of the wealth transfer or the wrong side. The banks are buying. The central banks are buying. The industrial users are buying. The smart money across every category is buying this crash. The only people selling are retail investors who fell for the psyop, who looked at a manufactured price drop and concluded it meant something real, who forgot why they bought silver in the first place, who let fear override reason. Don't be that person. The crash to $28 is not the end of the silver story. It's the best chapter of the silver story for anyone with the courage to turn the page. The manipulation is temporary. The fundamentals are permanent. The opportunity is now. Simple currency. Simple opportunity. Load up at $28. You'll never see these prices again.